So this hearing is entitled Gamestop: Who Wins and Loses When Short Sellers, Social Media, and Retail Investors Collide. I now recognize myself for 3 minutes to give an opening statement. Good afternoon, everyone. This hearing will be the first in a series of hearings for the committee to examine the recent market volatility involving GameStop and other stocks. I want to know how each of the witnesses here today and the companies they represent contributed to the historic trading events in January. This recent market volatility has put a national spotlight on institutional practices by Wall Street firms and prompted discussion about the evolving role of technology and social media in our markets. These events have illuminated potential conflicts of interest and the predatory ways that certain funds operate, and they have demonstrated the enormous potential power of social media in our markets. They have also raised issues involving gamification of trading, potential harm to retail investors, and the business models of apps with retail investors as their users. All of this is why we have witnesses from many of the key players here to testify today, including witnesses representing Wall Street firms Melvin Capital and Citadel, social media company Reddit, trading app Robinhood, as well as one of the retail investors involved. In subsequent hearings, we will hear from regulators and other experts regarding these events, including why Dodd-Frank rulemakings related to short-selling disclosures were never implemented. Many Americans feel that the system is stacked against them, and no matter what, Wall Street always wins. In this instance, many retail investors appeared motivated by a desire to beat Wall Street at its own game. And given the losses that many retail investors have sustained as a result of volatility in the system, there are many whose beliefs that the system is rigged against them has been reinforced. Others have noted that there are winners and there are losers in every trade in our financial markets. Our role as a Financial Services Committee is to ensure fairness in our financial markets and system, robust protections for investors, and accountability for Wall Street. Today, we will hear firsthand from the witnesses regarding these events. The hearing will be an opportunity for this committee to get the facts about the role each of the entities the witnesses represent played in the events we are examining today.
I think if we've learned anything from the past few weeks, it's that these average everyday investors are pretty darn sophisticated. There is wisdom to the crowd. So let's zoom out on that idea just for a moment. The GameStop story represents a larger truth. A fundamental change is happening. Like never before, everyday investors can communicate, access more information, and work collectively to move markets, all in real time. Technology is fueling this revolution. Congress cannot put technology back in the box. GameStop is a culmination of years of pent-up frustration. That frustration is now paired with faster, cheaper, and better technology. Consider for a moment that for every story of someone being able to pay off their student debt from the GameStop trade, or conversely, every story of someone who lost money, there were stories of those who said they were investing in protest. In protest, they would gladly risk losing money just to prove a point. And now, while no one should ever risk investing money that they cannot afford to lose, let's tell the truth of why someone would do something like that. The sad truth is the K-shaped economy is nothing new in our capital markets because the structural core of our regulations literally enshrined inequity. Policies like the accredited investor definition blatantly pick winners and losers. If you're wealthy, you're good to go. And if you're not, you're deemed too dumb to be trusted with your own money. So a privileged few get to invest alongside Ivy League endowments, getting early access in private markets to the greatest returns of the last 2 generations. But not so fast for the average everyday investor. In the eyes of our government, you need to be protected. Protected from your own decisions, protected from your own money, protected from more opportunities. So I'll conclude with a reminder for some of my colleagues who want to regulate more and more. In the 1980s, Massachusetts state regulators barred citizens from investing in what the Wall Street Journal called the latest in a cascade of stocks of high technology companies that occurred that year. What IPO was too risky in the eyes of the government? Apple. So instead of shutting the American public out through new regulations, new forms of taxation, or so-called protections, let's use this opportunity instead to side with them. So I'll begin where I started. Americans are far more sophisticated, informed, and capable than folks in DC give them credit for. And it's time our securities laws treat them that way.
Back in the day, the law school professor would create an exam where he'd weave together a story that would exemplify each of the issues in that area of the law. But never did the professor do it as good a job as the Gamestop saga, which identifies most of the issues facing our capital markets. Short selling. Could there be limits or required additional disclosures? What do we do with market participants, whether they be on Reddit or on Wall Street, who are shorting a stock or buying a stock for the purpose of influencing its price? What is this payment for order flow model? And what does it mean when some participants get best execution and some get enhanced best execution? The price enhanced best execution, and all traders being treated fairly, and is payment for order flow free to the consumer? We need to look at the plumbing, where it takes 2 days to settle a transaction, but also why is it the broker's capital rather than the customer's capital that is posted during the 2-day period? And finally, we need to look at the gamification and glorification of high frequency trading.
Very much, Madam Chair. I greatly appreciate the opportunity to express some concerns that I have. It is a fact that Citadel Securities has paid over $100 million in penalties. And my concern is this. It deals with whether we can allow a market maker's profits from misleading clients and improperly trading ahead of clients to become something as simple as the cost of doing business. The risk of punishments for violations must always exceed the rewards to deter the risk. I'm concerned, and my hope is that we'll get some additional intelligence on how these punishments have impacted the rewards that have been received. I yield back.
Now, before we begin with the oral testimony, I would like to swear in the witnesses. I will call each of your names individually to respond. Would you please raise your hands? Do you solemnly swear to affirm that the testimony you will give before this committee in the matters now under consideration will be the truth, the whole truth, and nothing but the truth? So help you God. Mr. Chen?
I do.
Mr. Griffin?
I do.
Mr. Plunkett? Mr. Plunkett?
I'm muted. I apologize. I do.
Thank you. Mr. Huffman?
I do.
Mr. Gill?
I do.
Ms. Clark?
I do.
You've invited me today to discuss the events of last month, and I welcome this opportunity. In late January, many brokerage firms saw a massive increase in trading activity in a handful of stocks. Prices were moving dramatically day to day, even hour to hour. One specific day, January 28th, proved to be a completely unprecedented event. The spike in trading activity and volatility meant that Robinhood Securities, our clearing broker, had to hold the line and post additional firm capital as collateral to support our clearinghouse deposit demands. To put it in perspective, on January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities, along with many other firms, imposed temporary trading restrictions on certain securities. We began allowing limited buys of these securities the following day, and we've since lifted the restrictions entirely. There are 2 points I want to make clear about these temporary restrictions. First, Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements, not to help hedge funds. We don't answer to hedge funds. We serve the millions of small investors who use our platform every day to invest. Second, Robinhood immediately secured additional funds. Altogether, through capital raising and other measures, we've increased our liquidity by more than $3 billion to cushion ourselves against increased collateral requirements and related market stress in the future. Despite the unprecedented market conditions in January, at the end of the day, what happened is unacceptable to us. To our customers, I'm sorry and I apologize. Please know that we are doing everything we can to make sure this won't happen again. And I want to highlight one more thing. The existing 2-day period to settle trades exposes investors and the industry to unnecessary risk. There is no reason why the greatest financial system in the world cannot settle trades in real time. I believe we can and should act now to deploy our intellectual capital and our engineering resources to move to real-time settlement. Together, we can solve this.
This hearing is a decision of stock trading platforms to limit trading in GameStop. I want to make clear at the outset that Melvin Capital played absolutely no role in those trading platform decisions. In fact, Melvin closed out all of its positions in GameStop days before the platforms put those limitations in place. Like you, we learned about those limits from news reports. I also want to make clear at the outset that, contrary to many reports, Melvin Capital was not bailed out in the midst of these events. Citadel proactively reached out to become a new investor, similar to the investments others make in our funds. It was an opportunity for Citadel to buy low and earn returns for its investors if and when our fund's value went up. Melvin specializes in the consumer and technology sector, including companies like GameStop, AutoZone, and Expedia. Most of our investments are long. In other words, we buy stock in companies that create jobs, grow the economy, and develop new products for consumers. We do this after extensive fundamental research, sometimes literally for years. When our research convinces us that a company will grow relative to expectations, we make a long-term investment. When our research suggests a company will not live up to expectations and its stock price is overvalued, we might short a stock. Like with our long positions, our practice is to short a stock for the long term after extensive research. We also short stocks because when the markets go down, we have a duty to protect our investors' capital. There are laws governing shorting stock, and of course, we always follow them. In addition, it's very important to understand that absolutely none of Melvin's short positions are part of any effort to artificially depress or manipulate downward the price of a stock. Nothing about a short position prevents a company from achieving its objectives. It is just Melvin's view about whether it will. Specific to GameStop, we had a research-supported view well before the recent events. In fact, we had been short GameStop since Melvin's inception 6 years earlier, because we believed and still believe that its business model, selling new and used video games in physical stores, is being overtaken by digital downloads through the internet. And that trend only accelerated in 2020 when, because of the pandemic, people were downloading video games at home. As a result, the gaming industry had its best year ever, but GameStop had significant losses. In January 2021, a group on Reddit began to make posts about Melvin's specific investments. They took information contained in our SEC filings and encouraged others to trade in the opposite direction. Many of these posts were laced with anti-Semitic slurs directed at me and others. The posts said things like, "It's very clear we need a second Holocaust. The Jews can't keep getting away with this." Others sent similarly profane and racist text messages to me. In the frenzy during January, GameStop stock rose from $17 to a peak of $483. I do not think anyone would claim that the price had any relationship to the intrinsic value of the business. The unfortunate part of this episode is that ordinary investors who were convinced by a misleading frenzy to buy GameStop at $100, $200, or even $483 have now lost significant amounts. When this frenzy began, Melvin started closing out its position in GameStop at a loss. Not because our investment thesis had changed, but because something unprecedented was happening. We also reduced many other Melvin positions at significant losses, both long and short, that were the subject of similar posts. I'm personally humbled by what happened in January. Investors in Melvin suffered significant losses. It is now our job to earn it back. And while I do not think that anyone could have anticipated these events, I've learned much from them and I'm taking steps to protect our investors from anything like this happening in the future.
I'd like to share a bit about how content moderation on Reddit works. Reddit's moderation system starts with our content policy, the platform-wide rules which all communities must follow. Among other things, these rules prohibit hate, harassment, bullying, and illegal activity on Reddit, and they are enforced by Reddit's anti-evil team, which is composed of engineers, data scientists, and other specialists. This team also ensures the integrity of the site, and we have continuously honed our methods to stay ahead of bad actors to protect Reddit from manipulation, spam, and other threats. This team searched high and low for the specific comment mentioned in the previous testimony, or anything like it. The closest we could find was a single comment that received no votes and was deleted within 5 minutes. Such speech is not tolerated on Reddit, and we will of course investigate any further claims of this nature. Centralized moderation is common, but Reddit additionally uses a governance structure akin to a federal democracy, where the aforementioned policies and teams represent the federal government and the communities themselves represent states. All communities, or subreddits, are created by users that we call moderators. They set the community's rules, which may be as strict as they like as long as they are not in conflict with the platform-wide policies, and they have a variety of tools of enforcing these rules independently. Moderators are not paid employees, but rather users who are passionate about their communities. They have the context and judgment to make decisions no algorithm could. The members of each community contribute both the content itself and the ranking of it by voting up or down on any post or comment. Unlike other platforms where submission has a built-in audience through the author's follower count, every piece of content on Reddit, no matter how famous the author, starts at 0 and has to earn its visibility. Through their votes, the community itself enforces not just the explicit rules of their community, but also the unwritten rules that define their culture. This layered approach has helped our users create the most authentic communities online. The specific community we'd like to talk about today is Wall Street Bets. It's important to understand that Wall Street Bets is one of many finance and investing related communities on Reddit. This particular community specializes in higher risk, higher reward investments than what you might find in other more conservative financial communities on Reddit, with such names as personal finance, investing, and financial independence. I will stress that Wall Street Bets is first and foremost a real community. The self-deprecating jokes, the memes, the crass at times language all reflect this. And if you spend any time on Wall Street Bets, you'll find a significant depth to this community exhibited by the affection its members show one another. They are just as quick to support a fellow member after a big loss as they are to celebrate after a big gain. A few weeks ago, we saw the power of community in general and of this community in particular when the traders of Wall Street Bets banded together at first to seize an investment opportunity not usually accessible to retail investors, but later more broadly to defend all retail investors against the criticism of the financial establishment. With the increase in attention, Wall Street Bets unsurprisingly faced a surge in traffic and new users. At Reddit, our first duty in these situations is to our communities, and our role in this moment was to keep Wall Street Bets online. Working around the clock, we scaled our infrastructure, made technology changes to help this community withstand the onslaught of traffic, and we acted as diplomats to help resolve conflict within Wall Street Bets leadership. We have since analyzed the activity in Wall Street Bets to determine whether bots, foreign agents, or other bad actors played a significant role. They have not. In every metric we checked, the activity in Wall Street Bets was well within normal parameters, and its moderation tools were working as expected. We will, of course, cooperate with valid legal requests from federal and state regulators. That said, we do believe that this community was well within the bounds of our own policies. To conclude, I would like to reiterate why it is important to protect online communities like Wall Street Bets. Wall Street Bets may look sophomoric or chaotic from the outside, but the fact that we're here today means they've managed to raise important issues about fairness and opportunity in our financial system. I'm proud they use Reddit to do so. Thank you, and I look forward to your questions.
Thank you, Chairwoman Waters, Ranking Member McHenry, members of the committee. I'm happy to discuss with the committee my purchases of GameStop shares and my discussions of their fair value on social media. It is true that my investment in that company multiplied in value many times. For that, I feel enormously fortunate. I also believe the current price of the shares demonstrates that I've been right about the company. A few things I am not. I'm not a cat. I am not an institutional investor, nor am I a hedge fund. I do not have clients, and I do not provide personalized investment advice for fees or commissions. I'm just an individual whose investment in GameStop and posts on social media were based upon my own research and analysis. In early June of 2019, the price of GameStop stock declined below what I thought was its fair value. I invested in GameStop in 2019 and 2020 because, as I studied the company, I became more and more confident in my analysis. Two important factors, based entirely on publicly available information, gave me confidence that GameStop was undervalued. First, the market was underestimating the prospects of GameStop's legacy business and overestimating the likelihood of bankruptcy. I grew up playing video games and shopping at GameStop, and I plan to continue shopping there. GameStop stores still provide real value to consumers and reliable revenue for GameStop. Second, I believe that GameStop has the potential to reinvent itself as the ultimate destination for gamers within the rapidly growing $200 billion gaming industry. GameStop has a unique opportunity to pivot toward a technology-driven business. By embracing the digital economy, GameStop may be able to find new revenue streams that vastly exceed the value of its business. I am hardly the only person who has advocated these points. When I wrote and spoke about GameStop in social media with other individual investors, our conversations were no different from people in a bar or on a golf course or at home talking or arguing about a stock. Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources. Social media platforms like Reddit, YouTube, and Twitter are leveling the playing field. The idea that I use social media to promote GameStop stock to unwitting investors and influence the market is preposterous. My post did not cause the movement of billions of dollars into GameStop shares. It is tragic that some people lost money, and my heart goes out to them. But what happened in January just demonstrates again that investing in public securities is extremely risky. I also want to say that I support retail investors' right to invest in what they want, when they want. I support the right of individuals to send a message based on how they invest. As for me, I like the stock. I'm as bullish as I've ever been on a potential turnaround for GameStop, and I remain invested in the company.
My name is Jennifer Schulp, and I'm the Director of Financial Regulation Studies at the Cato Institute's Center for Monetary and Financial Alternatives. Thank you for the opportunity to take part in today's hearing. Before addressing the GameStop phenomenon specifically, I'd like to talk about the participation of retail or individual investors in our public equities markets. Retail participation has ebbed and flowed over the years, but the recent upward trend accelerated sharply during the pandemic. Most point to zero commission trading, but several other factors also likely attracted retail investors, including fractional share trading, low account minimums, and easy app-based platforms. More time at home during the pandemic probably even played a role. Retail participation in our equities markets is important. The fact that retail investors behave differently from institutional ones and differently from each other can be particularly valuable in times of market stress. In fact, individual investors may have helped stabilize the market in March 2020. Importantly, investing in the stock market also provides a path to wealth for individual investors. But stock ownership traditionally has been skewed towards the already wealthy, and it is highly correlated with race, education, and age. Retail investors making up this new surge are different. Recent research by the FINRA Investor Education Foundation and NORC at the University of Chicago found that investors who opened accounts for the first time in 2020 were younger, had lower incomes, and were more racially diverse. These new investors also held lower account balances. This may portend, as one of the researchers noted, quote, a shift towards more equitable investment participation. These new opportunities for individuals to grow their wealth should be welcomed and expanded, not restricted. Now I'll turn to GameStop. At the outset, I will note that it is difficult to analyze the impact of the trading in GameStop and other stocks because many facts are unknown. But some things seem clear. Importantly, the temporary volatility in these stocks did not present a systemic risk to market function. As the Treasury Department recognized, the market's, quote, core infrastructure was resilient during high volatility and heavy trading volume. This is not surprising. Despite the huge trading volume and rapid increase in value, only a small part of the market was affected, and spillover effects on the wider market were mild and short-lived. The fact that GameStop traded temporarily, and perhaps still trades above fair estimates of the company's value, is not, by itself, a reason for concern. Stock prices move in and out of alignment all the time, and markets are no strangers to bubbles. If a company is valued by the market differently than a review of its fundamentals suggests, it might indicate that the analysis is missing relevant information about a company's prospects, or it might indicate that the company's stock price is due for a correction. The market's mechanisms, including the tool of short selling, generally work well to handle these circumstances. Stepping in to prevent trading where a stock price moves contrary to conventional wisdom could deprive the market of important information. The SEC, among a host of others, is reviewing the relevant trading and conducting a study of the events. The SEC will have access to far more information than has been made publicly available, and I believe it has the tools necessary to address any harmful misconduct that may have occurred. I cannot opine on whether any regulatory changes are warranted on this incomplete record. I tend to believe the answer will be no in light of the minimal impact on the market's function. But as regulators learn more, there may be areas identified for improvement. By no means, though, should these events lead to restrictions on retail investors' access to the market.
The market volatility surrounding GameStop and other securities has highlighted how many people feel that the cards are stacked against them, and that market participants, like our witnesses, hide the ball. Mr. Teneve, you explained that Robinhood restricted transactions in certain securities to meet demands coming from your clearinghouse. And yet, on January 28th, you represented to the media that there was no liquidity problem. Isn't it true that being concerned about having enough capital to meet deposit requirements, isn't that a liquidity problem? Could you just answer yes or no? For my 5 minutes, I don't have time. I just need a yes or no answer.
I stand by my statement. The additional capital we raised wasn't to meet capital requirements or deposit requirements.
The gentleman,
Excuse me.
I'm reclaiming my time. This liquidity problem had real consequences for your customers, but I wonder if they were all that surprised. Between December 2019 and December 2020, Robinhood customers experienced monetary losses due to system outages. Customer accounts were reportedly compromised. The firm repeatedly failed to testify its best execution obligations, and it misled its customers regarding its revenue sources. It seems retail investors often get a bad deal at Robinhood. Mr. Teneve, also, while you testified today that, quote, Robinhood's customers benefit greatly from payment for order flow, quote unquote, in December 2020, the SEC charged Robinhood for not disclosing that it was getting paid to send customer trades to Citadel Securities and other market makers, and for not seeking the best terms for its customers' orders. Robinhood provided such inferior trade prices, it cost your customers over $34 million. Is your testimony after Robinhood paid, is it your testimony after Robinhood paid the SEC $65 million to settle those charges, that this conflict of interest is in your customers' best interest? Yes or no?
Chairwoman Waters, first let me say regulatory compliance is at the center of everything that we do. We've made mistakes in the past. I'm not claiming that I'm perfect.
Yes or no to that question?
So Citadel Securities is an important counterparty. Nobody's denying that. The reason that—
Gentlemen, can I answer yes or no? I'm reclaiming my time. Meanwhile, Mr. Griffin, Citadel's role in this event also raises significant questions for policymakers. Citadel Securities pays Robinhood tens of millions of dollars to process trades by Robinhood's customers. This relationship gives Citadel Enterprise key non-public information as to direction and volume of trades by retail investors. Your firm makes use of private exchanges called dark pools and other off-exchange trading to trade large sizes without moving the market against you. In fact, at some point last month, 50% of all trades occurred in dark pools or via OTC off-exchange trades. Your business strategy is designed intentionally to undermine market transparency and skim profits from companies and other investors. One problem, though, Mr. Griffin, is that we don't really know how central your firm has become to the capital markets. Mr. Griffin, does Citadel handle 47% of the U.S. listed retail volume? Please, yes.
To my knowledge, we handle in excess of roughly 40% of all retail volume.
Thank you very much for reclaiming my time. Mr. Griffin, on January 27, did Citadel execute 7.4 billion shares for retail investors, which would be more trades than the average daily volume of the entire United States equities market in 2019? Yes or no?
Chairman Waters, that was my written and oral testimony.
All right, thank you. Mr. Tanev, I'm going to come to you first. I just want to get to what happened on that day in January. So let's take a step back here. You get a call in the middle of the night, according to what I've heard you in interviews say. And based off that conversation with your compliance team, you decided to halt the buying of GameStop stock. People were furious. We'll get into the regulations and the settlement parts of that today. We will get to that. But this is what I think needs to be answered about your decision. Why did Robinhood restrict the buying but not the selling of GameStop? And why did folks get locked out on the buy side only?
Ranking Member McHenry, I appreciate the opportunity to address that. The reason that Robinhood, first of all, let me say Robinhood is always committed to providing access. It's in our name. It's in everything that we do. The decision to restrict GameStop and other securities was driven purely by deposit and collateral requirements imposed by our clearinghouses. So buying securities increases our collateral requirements. Selling does not. Moreover, preventing customers from selling is a very difficult and painful experience where customers are unable to access their money. So we don't want to impose that type of experience on our customers unless we have no other choice. And even though I recognize customers were very upset and disappointed that we had to do this, I imagine it would have been significantly worse if we prevented customers from selling.
Okay, so let me ask this question. Is payment for order flow legal?
Yes, payment for order flow is legal and regulated and a common industry.
And is this disclosed to those users of your app?
Yes, payment for order flow is disclosed in multiple places. And moreover, payment for order flow enables commission-free trading. And that's why it's become the industry standard model, as other brokerages have replicated our model and started offering commission-free trading to their customers as well.
Okay, so to this greater point of what happened that day and the model that you're using, let's be crystal clear. That decision you made to restrict the buying but not the selling of GameStop was based on pressure from anyone on the witness panel here today?
Not at all. Zero pressure from anyone. It was a collateral depository requirement decision made by our Robinhood Securities president.
All right, so let me get into this other question. Let me get into this question. You want to democratize finance. You want to open up Wall Street to retail investors. You say that Robinhood's mission is to democratize finance for all. So let's talk about that. So yes or no, can a Robinhood customer invest in Robinhood, the company?
Robinhood's currently a private company, so that's not possible, no.
And so you mean to tell me that the people that use your platform, that make you a successful company, and I would say directly contribute to your company's exponential growth and success, they don't get the same access to equity shares as a Robinhood employee or your institutional investors. Is that correct?
Currently, that is correct, yes.
All right, Ms. Schultz, let me pivot to you. Why is that? Why is it that everyday investors on the Robinhood app, people that I would argue contributed to its success, can't invest in Robinhood itself?
The SEC limits a lot of investment in private companies to those folks that are known as accredited investors. And to become an accredited investor, you have to have meet a wealth test of earning at least $200,000 a year or having a net worth of over $1 million. The vast majority of people in this country don't meet that standard and are unable to invest in most private companies.
Okay, so let me just clear this. Mr. Tinev, I don't blame you for the restriction you put on your customers not being able to invest in equity. I'd like to have more opportunity to ask Mr. Gill his thoughts on this, but let me just say this. I don't fault you for the inequitable regulatory structure that DC has created, but I think we need to clear this up. Final thing, Madam Chair, I have for the record, I'd like to submit a letter from the DTCC, which is the clearing company, that was not on the panel today, and your staff has this letter ready.
Order.
All right, thank you all, and look forward to getting to the facts of the matter here
From
today.
other members, Ms. Maloney.
Thank you, Chairwoman Waters and Ranking Member McHenry for convening this hearing. I hope today's hearing sheds light on how our markets are working, or in many cases are not working, for smaller investors and ways we can fix that. The events of late January saw tremendous volatility and stock prices that were totally divorced from market fundamentals. The whole enterprise was viewed by some as a giant video game, trading stocks instead of properties and monopoly money. But it's not all fun and games, because people can lose their life savings, their hard-earned cash, and tragically, last summer we know of at least one suicide linked to potential trading losses. Beyond those possible losses, the actions of Robinhood and other trading platforms during the GameStop frenzy caused confusion, anger, and undermined investor confidence in the fundamental fairness of our capital markets. None of this is healthy for our markets or good for investors. What makes markets work fairly is when everyone knows the rules and that the rules remain consistent and predictable and are enforced. But because of Robinhood's actions, too many customers did not get that predictability. Many retail investors woke up on January 28th to find that they could no longer buy and sell stocks the same way they could the days prior, and they were being treated differently than other market participants who could still buy and sell those same stocks. So I don't blame them for thinking that things were stacked against the little guy. Mr. Tinev, you stated in your testimony that Robinhood restricted trading for certain securities, including GameStop, in order to meet your financial requirements with your clearinghouse. But when I go to Robinhood's website and the blog post you initially released on January 28th, your financial requirements with your clearinghouse are not mentioned. You only mention market volatility. And when I review the Robinhood customer agreement, you don't include specifics on how and when you may decide to restrict trading, which you did. And you don't include any language or disclosures regarding your capital requirements. It only includes vague language that at any time and in its sole discretion, Robinhood can restrict trading. In other words, you seem to reserve the right to make up the rules as you go along. So I have two questions for you. First, do you think you owe your customers more disclosure and transparency than you gave them? And second, do you believe your lack of candor with your customers might have contributed to the wild speculation and confusion that resulted in the aftermath of your trading restrictions?
Congresswoman, I appreciate the question. So to answer the second question, look, I'm sorry for what happened. I apologize, and I'm not going to say that Robinhood did everything perfect and that we haven't made mistakes in the past, but what I commit to is making sure that we improve from this, we learn from it, and we don't make the same mistakes in the future. And Robinhood as an organization will learn from this and improve to make sure it doesn't happen again. And I'll make sure of that.
Well, I expect we will experience future events with increased volatility, and Robinhood's recent actions appeared arbitrary, which is why I don't blame customers for feeling treated unfairly. Your trading restrictions came out of the blue, and your communication was not clear. So my next question, Mr. Tinev, looking forward, what operational changes is Robinhood making to better respond to future market volatility, to improve transparency with your customers, and to ensure retail customers don't get the rug pulled out from under them at the last minute?
Thank you for that question, Congresswoman. We'll be committing to reviewing absolutely everything about this. The $3.4 billion that we raised, I think, goes a long way to cushioning the firm from future market volatility and other similar black swan events. And I believe that even throughout this process, we improved our risk management processes and strengthened them so that the experience customers had on Friday of that week was much improved from Thursday.
Thank you.
We'll continue to learn and improve upon this.
Ms. Wagner, you're recognized for
Thank you, Madam Chairwoman. I'd like to welcome our witnesses for testifying today to discuss the late January market volatility that took place, along with what I hope is a broader discussion on market functions and their effect on everyday investors. Since I was very first elected, I have advocated for America's Main Street investors and worked tirelessly to ensure that all Americans, especially those low and middle income savers, are given the investment choice, access, and affordability that they deserve. Retail investors are the strength of our stock market, and I have fought throughout my career for their best interests in the financial markets, and this hearing today is no different. The advances in financial technology that we've witnessed in the last decade have improved the way that Americans and our businesses perform financial activities. In just the past year, we have seen retail investors' market participation more than double. And I think this is great. I believe in the wisdom of the retail investor, and I will say I believe in the First Amendment too. This increase is attributed to Robinhood and other trading brokerages who are lowering account minimums, permitting fractional share trading, and implementing zero commission trading. It is critical that Congress focus on reducing barriers to market participation, which is rarely want to do, let me sadly say, and allowing Main Street Americans access to the financial instruments that can create long-term investment savings. All of these changes have given millions of Americans the ability to invest better for their families and their future. My hope is that the majority does not use this hearing as an excuse to once again add new federal regulatory burdens to an industry that is already heavily regulated, that will prevent people from participating in our capital markets. Letting existing regulations work is key, not burdening everyday investors with new and more costly barriers to entry. Mr. Tanev, it appears at the time your company did not have enough money to meet the collateral requirements for that level of trading by your customers. In your view, A, were collateral requirements from the DTCC unreasonably high? Was the amount of trading on your platform unforeseeable, or was your company undercapitalized given its risk profile?
Thank you for the question, Congresswoman. So this event was a 5 Sigma event, which is a 1 in 3.5 million event. To put that in context, there have only been tens of thousands of stock market days in the history of the US stock market. So a 1 in 3.5 million event basically is unmodelable. That said, we can learn from it. And in this particular case, our risk management processes worked appropriately to keep us in compliance with all of our deposit requirements and collateral requirements.
Well, Mr. Tanev, I realize that you are doing a full review of your practices and such. I encourage you to do that. And certainly communication with your investors is going to be key to that because you didn't communicate with them early on. Let me just say, as a ranking member on the Diversity and Inclusion Subcommittee, I am delighted to be speaking with our witness, Ms. Jennifer Schulp. Ranking Member McHenry and I have spent countless hours stressing the importance of having qualified women in finance. So I'm pleased to have you here today to lend your expertise. Ms. Schulp, we now know that it was the daily collateral demands set by the National Security Clearing Corporation that were the reason Robinhood had to temporarily restrict trading. Can you briefly explain the purpose of these capital requirements and their overall relationship to ensuring our markets function in an orderly manner? And did you see any broad failures of market function during these events, ma'am?
Sure, thank you. Thank you for the compliment. The NSCC's collateral requirements here serve the function to provide security for the stock settlement process goes through. So while an investor thinks that what has happened is they bought a stock on the day that they make a trade, it really takes 2 days for the settlement process to clear. During that time, the brokerage firm, the DTCC, and the brokerage firm on the other side can remain at risk of that stock not actually clearing. And the collateral requirements are in place in order to mitigate the risk that the brokerage firm will not be able to make good on its promises to sell or buy. I didn't see any broad scale failure here. The DTCC's collateral requirement was large, but understandable. And I think things functioned largely correctly.
My first question to Mr. Tenhip, let's talk about the attention that this pay for order flow has received. You explained in your testimony, Robinhood's relationship with market makers is important for Robinhood's ability to offer commission-free trading. So expand, if you would, on how that process benefits the everyday investor. And just expand in general on that, if you would.
Congressman, I'd be happy to. Thanks for giving me an opportunity. So as I mentioned in my written testimony, payment for order flow enables commission-free trading. Prior to Robinhood changing the industry standard model to be commission-free, most brokers collected a commission on top of the payment for order flow on every transaction. Now, Robinhood routes to market makers, including Citadel Execution Services. We've got 7 in total across equities and options. And we route without consideration for payment for order flow. All payment for order flow arrangements are uniform across the market makers. And our system routes orders based on who provides the best execution quality for our customers. So the reason Citadel gets a relatively high percentage of our customer order flow is because they provide superior execution quality for our customers. And that's first and foremost the most important consideration that we look for. How are our customers getting the best execution quality? If another market maker were to improve upon the execution quality that Citadel Execution Services provides on any subset of orders, our system is set up to automatically route more traffic to that market maker.
Continuing down this line, because clearly this is one of the things that my colleagues and the public has a very strong interest in. And having lived through Dodd-Frank before, I see where sometimes major things can occur. I want to turn to Mr. Griffin. Now, could you also elaborate on how payment for order flow provides, whether it's the best price to the retail investor from the market maker's perspective? Could you expand on that? As you outlined in.
Absolutely, Congressman. So as the CEO of Robinhood just set forth clearly, the orders that are allocated amongst the market makers today are allocated principally on the basis of price improvement. We have fought for 15 years to make that the basis by how which orders are allocated, because we strongly believe that Citadel is able to provide a better execution for retail orders in the long run. We make a huge investment in our team and our technology to do so. How is it that we are able to provide better execution quality than exchanges? Because exchanges are limited in their ability to do business by regulatory mandate. Exchanges by law have a minimum 1 cent wide market, which for low price securities means that they are less competitive than they otherwise could be. We're able to
How are you here and what are you doing?
Excuse me?
That wasn't either one of us. Continue, Mr. Griffin.
All right. So we're able to share our trading acumen with retail investors, and we're able to give them a better price, and we're able to make payments for order flow to firms like Robinhood that allow them to have lower, or today in most cases, no commission. And of particular note, we're able to help Robinhood and other brokers pay exchange fees to the exchanges at the time of execution. This has been very important to the democratization of finance. It has allowed the American retail investor to have the lowest execution cost they've ever had in the history of the U.S. financial market.
Kind of in the Dodd-Frank process that the chairman and I went through a decade ago, plus there was much.
I think it's important to emphasize that we have vigorously advocated for execution quality to be one of the dominant decision-making factors in the routing of order flow in the United States. This has saved retail investors billions of dollars over the year, in contrast to the executions that they would receive through other execution strategies.
Okay.
With respect to payment for order flow, we simply play by the rules of the road. Payment for order flow has been expressly approved by the SEC. It is a customary practice within the industry. If they choose to change the rules of the road, we need to drive on the left side versus the right side. That's fine with us. I do believe that payment for order flow has been an important source of innovation in the industry. As the CEO of Robinhood has testified, they drove the industry towards $0 commissions. This has been a big win for American investors.
Get to Ms. Sculp from Cato Institute, and I know that there was Greenwich Associates had a study, and others are out there. Do you concur that this has been good for consumers in the most part?
I think that there's still ongoing studies, but I do think that payment for order flow and the price improvements have largely been good for improvements for customers. And I agree with Mr. Griffin that this has helped drive innovation in the industry. I think disclosure can always be better, and I think people should understand that their broker still needs to make money even if they're providing a zero commission trading service.
Yeah. Okay. You thought you were here today, but I'm going to dispense with that because it's going to take too much time, and I'll provide the answer. Political theater for the most part. That's what this hearing is today. I mean, we're on the business channels right now and on C-SPAN. I think if you see a few of my colleagues playing to the cameras, but we need to have some of these fundamental and important questions answered at the end of the day. And one of the assertions that you've heard already today is that investing is, quote, casino gambling. It's using monopoly funny money. I guess I want to know, is individual retail participation in the marketplace gambling, casino gambling, or using funny money? Mr. Gill, why don't we just start with you? Very quickly. I don't hear him. Mr. Huffman, let's move to you.
No, I believe that investing is investing.
Okay. Mr. Griffin?
I believe the vast majority of retail participation are people saving to meet their dreams.
All right. Mr. Tanev?
Congressman, thank you. As I mentioned in my opening statement, Robinhood customers have essentially made over $35 billion in unrealized and realized gains on all of their assets.
It's investing for them, correct?
Absolutely, it's investing and it's building wealth.
Go back to Mr. Gill.
Yes, of course. I do. I believe it's an opportunity for investors to participate in the market just as institutionals participate.
Okay, so did you buy GameStop because you were not aware of the payment for order flow?
My investment in GameStop was based on the fundamentals.
Okay, I think that.
While I understand that short selling can be used for legitimate purposes, too often I have seen abuse, and it ends up harming ordinary workers and families. I first saw it against the people of Puerto Rico, and now we are seeing it here against GameStop. Large investors, including hedge funds like yours, have to disclose their long positions when they own 5% or more of the company's shares, but not such disclosure is required for short positions. As we consider reforms, is this type of disclosure for short positions something you will support? Mr. Plotkin?
Yeah, Congresswoman, thank you very much for the question. I think it's a really good question. Whatever regulation is put forth in the marketplace, we will obviously, operate within those rules. It's certainly something I'd be happy to follow up with.
But what about my question about short selling?
Yeah, I think it's a really good question. It's not really for me to decide, but if those are the rules, I'll certainly abide by them.
Be here today, we're discussing the actions around Robinhood, all the transactions that took place. And I guess, do you think we need more legislation as a result of what happened here, or did the system actually work? And let me just make a couple comments on that part. From the standpoint that did it work, was it self-correcting? Did the fact that somebody like yourself was able to invest and maybe take advantage of the over-shorting positions by the hedge fund guys who were trying to really drive down the price of the stock for other reasons, whatever, or did it point out perhaps that we had some companies, perhaps like Robinhood, I would argue that was undercapitalized or under-reserved? Or maybe there was over-aggressive other types of investing that was taking place. The algorithms that were there, the different business models, they didn't work because you outsmarted the system, so to speak. Would you like to comment on that, on that sort of questions and how I formatted that?
Thank you for the question, Congressman. I would say my expertise is in analyzing the business, the fundamentals of the business, not so much on the inner workings of the market. I'm not so sure about legislation per se. What I would say is that increased transparency could help. that if someone like me could have a better understanding of how those types of things work, I feel as though it would be quite beneficial to retail investors.
You made the comment in your testimony, Mr. Tevin, about settling this in real time. We have the electronic ability to do this. I think that will probably help the situation that occurred here. But what other problems occur when you do this in real time? What other things would we have to look at? What other unintended consequences would there be if you did something like that?
Thank you, Congressman, for the question. I believe that right now, certain market participants rely on next day settlement to be able to take advantage of intraday netting and run up larger one-sided positions in certain stocks with the knowledge that they can close those positions or reduce them by the time settlement happens. And I understand that would be a limitation to the trading activities of some of these institutions. So that's certainly one area to consider. The other is around securities lending. We'd have to make changes to how securities lending works. I don't think any of these are insurmountable challenges, and I'd be happy, as I mentioned earlier, to deploy our intellectual capital and our team's engineering resources to help solve these problems very quickly.
Thank you for that. You're short selling. I understand that GameStop stock was short sold 140%. And Mr. Plotkin, you made the comment in your testimony a minute ago that you were not trying to manipulate stock. Yet if you're short selling a stock 140%, for me on the outside looking in, it looks like that's exactly what you're doing. Explain to me why that's not manipulating the stock.
Thank you, Congressman. For us, I can't speak to other people that were shorted. Anytime we short a stock, we locate a borrow. Our systems actually force us to find a borrower. So we always, short stocks within the context of all the rules.
Mr. Griffin, would you like to comment on that? You guys are both market makers and brokers and hedge fund guys. I mean, you do all of it. Why is this not considered manipulating a stock whenever you can short sell at 140%? Don't you think there should be a limit on something like that?
So I believe that the short interest in GameStop was exceptional, and I'm not sure it's worth us delving into legislative corrections for a very unique situation in terms of the extreme size of the short interest. I will say that all of the large market participants, in fact, every bank, every hedge fund does have to comply with the requirement to borrow shares to short shares in the course of their day in and day out business. The practice of naked shorting was largely curtailed by SEC mandate years ago.
And we are looking on this committee of how we can protect our wonderful, precious financial system. We need it from you. What about you, Mr. Hoffman? Do you have anything? What steps is your company taking to guard against this? Anything at all?
Congressman, we spend a lot of time at Reddit ensuring the authenticity of our platform. So we've got a large team dedicated to this exact task. Everything on Reddit, all of the content is created by users, voted on by users, and ranked by users. And we make sure that that is authentic and as unmanipulated as possible. And in this specific case, we did not see any signs of manipulation.
Thank you, Madam Chair. I appreciate you calling this hearing. The American financial markets, I believe, are the envy of the world, but they're still imperfect. I would have liked to see this committee have a meaningful discussion about capital requirements and the T+2 clearing rules that may have contributed to some of Robinhood's customers not being able to purchase stock, including GameStop, for a period of time. But because the majority didn't include the SEC, the Depository Trust Clearing Corporation, or the National Securities Clearing Corporation to testify, we're left with what we have. That's because I believe the majority is attempting to use this hearing to drive a narrative about the U.S. capital markets being rigged. But I do have several questions. Mr. Tanev, you decided to stop allowing your users to buy GameStop and other stocks as a result of capital requirements on Robinhood securities. Is that correct?
That's correct, yes. Deposit requirements with our clearing houses.
And those got resolved, but for a period of time, some of your users could only sell and not buy, and that could have contributed to the stock actually going, not going up as fast because some of your users were prohibited from buying. Do you think that is possible that could have happened?
I shouldn't speculate on what could have happened if
there's more sellers than buyers. Does the stock price go down or up?
Well, to be clear, Robinhood, Congressman, is a minority of trading activity in these securities.
I understand, but if your buyers can only sell and not buy, then it clearly keeps you from putting upward pressure on the stock price. Is that correct?
On Thursday, customers on our platform could only sell, so there was no ability to buy. That's correct.
Right. So, I know, and you said earlier, by the way, I know some people have attacked your arbitration agreements, but I want you to be clear. If your users were harmed as a result of these actions, they can recover through arbitration. Is that correct? Yes or no?
Yes, that's correct. And our arbitration is FINRA supervised and overseen. And we do believe arbitration gives customers a fair and speedier resolution to their claims.
Thank you. Does your user agreement and your arbitration allow for group arbitration or only individual arbitration?
Let me get back to you on that.
There is a reason for penalizing a market maker for improperly trading its own accounts ahead of its clients' accounts. Note that I said improperly trading. I don't want to go through the scenario of there being a time for proper trading ahead of accounts. I'd like for you to tell us what that reason is, please.
Well, trading ahead of customer accounts is illegal, and it does not.
I understand that it's illegal. I don't mean to be rude, crude, and unrefined, but I have to ask this question quickly. What can happen that can benefit the market maker? How can that be monetized such that the market maker profits greatly from doing it?
Right. If a market maker trades improperly ahead of the own customer accounts, he can get a better price and can move the market in the process depending on how big the trade is, thus hurting the customer.
Yes, and if this trade is huge and you can see that this trade that the client has is huge and will have an impact on the market, how does that benefit the market maker to trade ahead of the client?
The market maker can get a better price for himself before the price changes by the client's trade. He can also engage in self-dealing that way as well.
So does it benefit a huge market maker to have a great deal with, let's say, a Robinhood because of the flow that will be coming through that the market maker can take advantage of?
I don't think that they're necessarily congruent situations. When you're trading ahead of a customer order, which is something that is illegal and that the SEC does monitor for, it's very different from having knowledge as to the way that the market might be moving based on.
I understand, but I want to talk about the circumstance where it's improper, not where it's proper. Remember, we started with improper trading. Here's my point. Let me go to it quickly. The market maker Citadel traded over-the-counter stocks for its own accounts in 2012, from 2012 to 2014, while simultaneously delaying client orders for the same shares. And it was fine for this. Citadel has been naughty for some time. 2014, Citadel faced $800,000 in penalties. 2017, 22.6 million. 2018, 3.5 million. 2020, 97 million. And another 2020 of 700,000. This seems like a lot of money. It is for me, more than $124 million. But over the same period of time, Citadel had revenues generated in the amount of $13.2 billion. It seems to me that the punishment for these improper trades and improper actions, because it wasn't just trading, Citadel also did some other things that were not proper. They misled clients. Seems that the punishment is so small given the amount of revenue generated over the same period of time. It seems that Citadel has at least an opportunity to build into its cost of doing business paying penalties. And that concerns me. It concerns me that the punishment doesn't seem to deter Citadel. It concerns me because I know of circumstances wherein persons who are not in the market, they do things that are much less harmful, and they can possibly go to jail. So the question that I have is this: what what kinds of systems do we have in place, and it's back to you again, ma'am, to prevent the very things that I have called to the attention of my colleagues?
Well, as a former enforcement attorney at FINRA, I can say that regulators have the same concern with fines and other punishments becoming just a cost of doing business. And it's one of the things that are considered along with the regulations around what can be punished.
The gentleman.
May I, for the record,
What impact might greater restrictions on the payment for order flow model have on your ability to offer zero commission trades?
We do believe, Congressman, that that's an important question, and payment for order flow helps cover the costs of running our business and offer commission-free trading to customers. When we started, people didn't even think that there was enough margin left to make this business work, but we've been fortunate to make it work and to make it work for our customers.
Well, let's talk about why Robinhood restricted trades. I think your explanation about margin requirements charged by your clearinghouse makes sense. Is your clearinghouse supervised by the Fed and the SEC?
I believe that.
Are the margin requirements charged by your clearinghouse in turn approved by federal regulators?
Yes.
And did federal regulators approve the value risk charge that was imposed on Robinhood?
I believe, Congressman, the value at risk charge is outlined in general terms in Dodd-Frank, but I'm not sure who approved the specific implementation of that formula.
So if anyone has a problem with your decision to halt trades, it's fair to say that their frustration should be directed toward federal regulation.
Congressman, I'm not trying to throw anyone under the bus and direct frustration anywhere. All I can say is Robinhood Securities played this by the books and played it basically the only way that we could remain in compliance with our deposit requirements.
Mr. Plotkin, I appreciate your testimony that Melvin always follows laws governing shorting stock, but Melvin lost $6 billion in 20 trading days. Let me ask you about your risk management. Did your short positions exceed float?
No, they did not.
Well, shorting has an important role to play in our markets, allowing for legitimate hedging and price discovery. But we are interested in naked shorting, and so we would hope that you would clarify that and how it is that you make sure that you're first locating the borrow.
Has expired. Mr. Cleaver, you're ready.
Ms. Schulp, thank you for being here. The Wall Street Bets Reddit platform. I'm curious, when you think about the obligation of this SEC pending investigation, based on your FINRA background, do you think the SEC should look at the bulletin board participants under Section 9A2 on potentially inducing trading in a certain direction? Is that worthy of their review?
Thank you for the question, Congressman. I think that there's been little evidence to this time that there's been any sort of false or deceptive conduct taking place on the Wall Street Bets Forum. That does not mean, though, that I think that the SEC should not take a deeper look. Because of the anonymity in the forum, there could have been people that were engaging in deceptive behavior that's not readily apparent to outside to the public. So I do think the SEC should look. But to this point, I've seen very little that would meet a test for manipulation, which generally involves false or deceptive behavior.
Thank you. I appreciate that. Mr. Tiev, I thought of another question for you. Would a securities transaction tax be beneficial to retail investors in the United States?
Thank you, Congressman. I don't believe it would.
Hearing was who wins and who loses. And I've spent a bunch of time in the last couple of days looking at the various players here. I'm pretty convinced that the wholesalers, Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time. Robinhood has a valuation of $5.6 billion and makes a lot of money from the casino. So who loses? And I want to spend some time talking about the person who usually loses, and that's the retail investor. And while I have supported for many years the democratization of finance, as we say, it's not just in Washington, D.C., but on Wall Street. The retail investor is known as dumb money. And there are any number of structures that are set up to take advantage of the retail investor. And I think it's worth looking at that, because as much as we're celebrating Mr. Gill here, we're not talking very much about Mr. Salvador Vergara, who was featured in a Wall Street Journal story, who took out a $20,000 personal loan through Robinhood, invested it in GameStop, only to see the value of his position go down 80%. So Mr. Vergara is out $16,000 he doesn't have, that he owes to somebody else. And as much as I support the democratization of finance, we need to be thoughtful about this. So Mr. Tenev, my question is for you. You quoted a $35 billion number as what I interpreted to be profits in excess of deposited funds and securities. If you just look at your customers who traded in GameStop over the period of its increase and subsequent decrease, Mr. Tenev, how did your customers in the aggregate do? Did they win or did they lose?
Much of our customers are investing for the first time and are taking money that they otherwise would have spent or consumed.
This hearing is a reminder that with complex situations, we should take time to understand what actually did or did not happen, especially with this GameStop situation. Now, the SEC is the proper authority to determine if any rules were broken, and they are looking into it. Congress has already given the SEC broad authority to oversee the capital markets, and we do not need to rush to enact even more big government regulations until we that could ultimately harm the investors. Now, question, Mr. Tenev, can you remind us, again, why Robinhood temporarily paused trading of GameStop and other stocks?
Of course. Thank you, Congressman. Robinhood paused trading temporarily, or I should say paused buying of about 13 securities on Thursday so that we could meet our regulatory deposit and collateral requirements.
Okay, so what you're saying is you were paused because you had to comply with regulations. Is that true?
Correct.
All right, so it's ironic that the people who are criticizing brokerage firms because they paused trading, which they sometimes have to do to comply with regulations, these same folks are now saying, we need to respond to this with more regulations. I would say if people don't like brokers occasionally having to pause trading, I'd suggest they look at the regulations that required it. At some point, we need to recognize that piling on more and more regulations only increases complexity and does not help investors. Question for Ms. Schultz. Despite the volatility and the frenzy of media and social media activity, it seems to me like the markets functioned as they were supposed to during this situation, and that markets are not broken. In fact, they are working well. Do you agree with that?
I agree with that.
Okay, thank you. I appreciate that. I think most reasonable people that are listening to this would agree that there are regulations in place. The SEC has those to pause activities that could be harmful, not only to the markets, but to the individual investors. And so what I'm understanding you saying is that it did work in the way it was supposed to.
As the facts that I know now, it does appear to have worked the way it was supposed to. This is not a sign to me that the market is broken.
Thank you. Mr. Griffin, what are some of the issues that policymakers should consider in the T+2, T+1, T+0 debate? Obviously, margin requirements exist to make sure firms have enough capital to settle transactions, but faster settlement and lower margin requirements can be positive for the retail investors, and we need to balance those needs. Can you address what some of the issues are in the T2, T1, and T0 debate?
So, Congressman, I cannot profess to be an expert on these issues, but I will give you my perspectives from having been in the industry for 30 years. We started at T5. We will one day be at real-time settlement. And the question is how long does that journey take? From T2 to T1, which reduces the amount of capital required by broker-dealers to meet the needs of their customers, that reduction in capital will be meaningful, would have been very helpful to Robinhood during this period of time. Reduces counterparty risk holistically, which is good for everybody in the market. We should push for T1. As we go to same-day settlement, you now bring into question the complexity of intraday cash movement, and you bring into play the necessity for all systems to be functioning every moment of every day with no room for error. On a T1 settlement cycle,
You only have a minute left, so let me just summarize. The financial transaction tax supported by many Democrats would do nothing to prevent market manipulation or fraud, would have not prevented the market disruption in January, and most importantly, would hurt retail investors. Yet Democrats are claiming that the events surrounding GameStop and Robinhood in January make it imperative to implement this financial transaction tax. It just doesn't add up. A financial transaction tax would make it more expensive for small retail investors to trade. And so much for looking out for Main Street. I believe we should be working together to find ways to open up markets to retail investors, not close them. Instead of making trade more expensive with a burdensome tax, let's look for ways to empower retail traders. Thank you, Madam Chair. I yield back.
Thank you to the witnesses. My first question is to the CEO, President Ken Griffin. In the first 3 quarters of 2020, your company paid online brokerages like Robinhood $700 million for their order flow. Do you believe that brokers like Robinhood can service the best interest of their users while selling their order flow to companies like yours? And that's yes or no.
Congressman, I believe that Robinhood actually goes further in meeting the best interest of customers by, in fact, routing their order flow to Citadel. We give a better price, a better execution for American retail investors than the alternative of going to exchanges.
So I'm going to take that as a yes, since you said they go further. Then can you tell me, why did your company urge the SEC to ban the payment for order flow models in a filing to the SEC?
Congressman, that is a terrific question. That filing relates to the U.S. options market. It was a filing back, I believe, in 2004. And in the U.S. options market at the time, trades were committed against listed quotes. We were apprehensive about the direction in which the U.S. options market was heading towards the existence of these price improvement auctions, which diminished the incentives to aggressively provide bids and offers in the options market. We felt that legislative or regulatory efforts to encourage tight quoting, to discourage the existence of these auctions, and this was being, in some sense, fueled by a series of payment for order flow programs, was in the best interest of American institutional and retail investors. Now, regretfully, we did not prevail in our reasoning. The rise of price improvement auctions came into, in essence, the day-to-day model for options trading in the United States. And I do believe that this is a setback for our capital markets.
So because my clock is ticking, let me ask you this. So are you saying that you no longer believe that the model is anti-competitive and distorts order routing decisions?
I think it's important to distinguish between a market where you must trade on an exchange. In the options market, we must print the trade on an exchange, versus a market where you can trade off exchange, which would be the U.S. equities market. So just to be very clear, because your question is very good, every single options trade must be executed on an exchange. Equity trades do not. And because of that, I can save Robinhood exchange fees and offer a tighter bid-ask spread.
Okay, clearly we're going to have a further discussion. Let me interrupt you only because my time is clicking, and I want to follow up with a question for Robinhood's CEO. Several of the brokers offer their users order flow for the sale to the firm, like with the previous CEO with Citadel. However, the price that Robinhood gets for the order flow is much higher than any other brokers receives. And I could go on and tell you, we've pulled the SEC filings that Robinhood receives 17% per 100 shares stock of traded and 58% to 100 shares, and I could go on. But the question is, why do companies like Citadel pay a premium for their order flows of Robinhood's users?
Thank you, Congresswoman, for that very important question. There's several reasons that may be the case. One important one is that our model and formula for payment for order flow works a little bit differently. We actually receive payment for order flow as a percentage of the bid-ask spread rather than on a per share basis. And we do believe that that's the most optimal way to structure payment for order flow arrangements.
Okay, is it not because companies like Citadel can make more money off of Robinhood users than others? And that's a yes or no, because my clock is going to run out.
No.
Mr. Tenev, do you believe that the root cause of January 28th for the problems that you and others experienced were market infrastructure related, particularly related to T2 versus T0?
I believe, thank you, Congressman. I do believe if we had real-time settlement capability and the infrastructure was modernized, we would not have seen similar problems.
Yeah, and thanks for that. I think, one of the related things, and it's related to your mission at Robinhood of more democratic access to capital, is not just the ability for more people in a broader portion of America to become savers and investors. It's also to engage in corporate governance even. So do you believe that if market infrastructure would guarantee, and this is really related to, the over, musical shares where someone could be left with no share when the music stops, multiple claims on a shorted stock. If the market infrastructure would guarantee an investor could retain custody of their shares so that the shares can't be lent to short sellers, there could be a downside. How do you feel that only one claim on the shares would resolve this? And that relates to proxy voting as well, or shareholders voting the shares.
Congressman, I believe that that's an important question. It's one that Robinhood and me personally have engaged with. I do believe that the ability for the same share to be shorted an indefinite number of times is somewhat of a pathology, and that should be fixed. And I think step one of that is modernizing the antiquated settlement infrastructure that everything is built on. We simply don't have the ability to properly track what shares have been shorted and how many times as they're moving through our settlement system currently.
Yeah, thank you for that. And I appreciate that you see the relationship. Hopefully broadly we do, and we provide that nudge the market.
Now, I have to ask this. You said that you didn't talk to anybody at Citadel Securities. Did anyone in your organization since January 1st contact Robinhood?
Are you asking if we've had contact with Robinhood?
With respect to GameStop and what we're obviously talking about.
So, Congressman, we offer to have my colleague who manages that relationship be here today instead. He has firsthand knowledge. We, of course, are talking to Robinhood routinely in the ordinary course of business. We manage a substantial portion of their order flow.
Well, I understand that, but did you talk to them about restricting or doing anything to prevent people from buying, not selling, but buying in GameStop?
Let me be
anybody in your organization.
Let me be perfectly clear. Absolutely not.
So if we depose everyone in your organization, we will find that.
That is correct.
Okay, thank you. I do want to ask you one thing, and Mr. Sherman was pursuing this. How do you balance the best execution for the order flow from your purchase from Robinhood with the need to profit from the purchased order flow? How do you do that?
So as a market maker, we have to provide to the customer a better price than they can achieve on exchange. Order flow is routed to us on the merits of the execution quality that we provide, in contrast to our competitors who we are competing with.
Mr. Huffman, what kind of authentication exists for Reddit users to confirm their identities, to verify they're even real people?
Reddit, and this is an important quality of Reddit, so thank you for the question, doesn't require people to reveal their full identity to use the platform. One of our pillars of privacy, and privacy is something that's critically important to us, is that users should be masters of their own identity, and they can choose to reveal as little or as much as they would like. I'll point out that there are two sides of this that are really important. On one side, this allows Reddit to work. Something like Wall Street Bets would not exist if users had to reveal their full identity, because in Wall Street Bets, people are revealing gains and losses. They're effectively revealing their financial position in life, and we would not put that burden on anybody to force them to do so. I'll point out that other platforms have real identity, and it doesn't do anything to improve their behavior.
Can I just ask a question of that? Is there any way for a regular user of Wall Street Bets subreddit to know what content is genuine, written by other users just like themselves, retail investors who are looking for honest information to invest on? Is there any way for that?
So there are a couple aspects to this. So the first is that we as a company invest significant resources in enforcing the veracity of our voting system. It's something we've been doing for 15 years, long before events like this, long before even the election and the politics of the last few years, where these things have become top of mind for everybody. This has been critically important to us. Also, our user base is exceptionally good at sniffing out untruths, misinformation, fake stories, both within this community and Reddit at large. And so in order for any piece of content to be successful on Reddit, it has to be accepted by that community and receive the same votes that anything else would.
Do you have any heightened standards for places like Wall Street Bets or other investing subreddits where moderators are able to manipulate content to their own financial gains?
We keep a high standard across the entire site. And in with this particular community over the past few weeks, we've been looking especially closely, anticipating these sorts of issues and questions. And to date, we have not found any nefarious behavior.
Got it, but
short selling. Citadel is now involved in another short selling problem, and Robinhood routes half of its customers to you, orders to you. Robinhood halts buying on a position that you're long on
and you own the hedge fund and the clearing broker, what is there to prevent you from taking advantage of that situation and making sure you profit off the confusion of retail investors?
So in no particular order, I just do not understand the reference to us owning a clearing broker. We do not own DTCC. We do not control DTCC. We are not party to the discussion, dialogue, or demands between DTCC and Robinhood. So I do not understand the premise of the question, because we have literally nothing to do with DTCC other than being a member of DTCC for providing settlement services for us and for doing real-time trade affirmation and clearing. Now, Citadel Securities owes a duty of best execution for every order that comes from Robinhood. And I will tell you that I'm incredibly proud of how seriously my team takes that duty of best execution. Some of the most earnest, hardworking, and thoughtful people that I've ever met in my life work on our retail execution business here at Citadel and take great pride in the execution quality that we give to each and every trader, not only at Robinhood, but at every single one of the retail.
Thank you for your response, Mr. Gill. But I understand that you made your position known on GameStop as far back as 2019 and are lauded as a diamond hands hero by Wall Street Bets community. Have you ever previously experienced or observed the type of restrictions Robinhood and other applications performed on January 28th?
Thank you, Congressman. No, I have not.
Thank you. That's a good question. And Mr. Huffman, I'm not a Redditor, but I do understand the problems around social media and freedom of speech and the tightrope act that goes on where these intersect. In the near decade of Wall Street Bets and subreddit, have they shown themselves to be exceptionally problematic, an exceptionally problematic forum, or just one of the many eccentric communities that call Reddit home?
Congressman, I think your latter description is more accurate. They are an eccentric community, but they're well within the bounds of our content policy. And though we do have difficult decisions to make here and there regarding specific communities, one of the things we look to first is whether the community is trying and they're putting their best efforts to be a good citizen of Reddit. And towards that end, we've had consistent communication with the moderators of that community, and they've been doing, I think, an excellent job.
Thank you. Well, the last financial crisis was caused when we turned a blind eye to the bad practices of our financial institutions. Perhaps today we've seen a warning about the clearing process, and I hope today can be a jumping off point for us to take a hard look at our markets and the practices of these institutions. In a two-day clearing process, the liability risk and potential financial stress limited trading, but in a key time in market and perhaps in a way that materially affected investors in these recent events. So I'm hoping that we all get to take a closer look at what is happening. And with that, I yield back. Thank you.
Certainly, there's been a significant amount of evidence supporting the advantages market makers offer retail investors. Through sophisticated infrastructure and high-speed technology, bid-ask spreads have decreased from 33 cents to less than a penny over the last 5 decades. And according to some research, saved retail investors $1.6 billion just in the first 6 months of last year alone. None of our discussion after this and the questions I'm going to ask are intended to be pejorative to that reality, but I just wanted to pick your brain, given your deep experience, about some of the implications of off-exchange trading specifically. We've seen this year that off-exchange trading has eclipsed nearly 50% of all trading. Can you talk a little bit about what factors have contributed to off-exchange trading's growth versus on-exchange trading? Certainly, I want to talk about the concerns we may have as market participants about that, but first, just the factors that you think are driving that.
I think one of the most significant drivers of off-exchange trading is that exchanges are handcuffed in their ability to fulsomely compete.
Can you talk a little bit more about that? Is this just regulatory arbitrage?
It is. I hate the word because it has a negative connotation. I believe that the exchanges should have greater latitude in setting their tick sizes in the most liquid securities.
Mm-hmm.
That will allow order flow that's currently going to dark pools to go to exchanges and to receive better executions. So let me just be very clear. It's not that we want to inhibit dark pools or market makers like Citadel from competing. It's that we want to enable and empower exchanges to be better competitors. I started my career as a retail investor in the day where I used to spend 25 cents in a bid-ask spread if I was lucky. I know the days you're referring to. We've come a long ways, but to continue on this journey, the next step is to allow exchanges to be more competitive in the market.
Well, so I think you answered this question, but just to put a fine point on it, there is public policy work that needs to be done in order to help resolve some of this challenge that exists in the movement of volume from on exchange to off exchange. That's incumbent upon us, it's incumbent upon regulators to find a better solution. Is that what you're saying?
Congressman, I'm saying that yes, it's legislators or the SEC. I believe much of this can be done by the SEC as a policy matter.
Right.
Think of it as the next step forward in regulation NMS.
Love it. Great. Thank you for all those answers. Just, I want to highlight this further. Can you talk about some of the challenges or deleterious impacts on the market if more and more volume is off exchange versus lit trading? Can you talk a little bit about why we should be concerned about that to make sure we all understand how important it is to make these changes to empower, as you said, exchanges to be better competitors?
I think there are three salient points I'd like to make. First, price discovery is the most important part of our capital markets function because price discovery combined with liquidity fuels our free enterprise system. It's how companies raise capital. It drives down the cost of capital. The more trading on exchanges, the better the price discovery we have. That is good for our capital markets. The second is that dark pools are often willing to engage in business practices where they discriminate against one class of investors versus another. I find it very unsettling that we in any way prohibit discrimination against one group of investors for the benefit or at the expense of another in any part of our capital markets. We want our capital markets to represent the values of our country. The third is that the dark pools themselves create a level of concern and apprehension about the integrity and fairness of our markets. And I believe that we should always be taking steps to advance public confidence and the confidence of retail investors and institutional investors that the United States capital markets are a fair place in which to transact business.
Mr. Griffin, thank you for those answers, and I'll call upon my colleagues to recognize the deep experience Mr. Griffin has in these areas and how important it is that we take the steps, either via agency or via legislation, to help empower exchanges.
Mr. Tenev, I'm going to start my questions with you by walking through a series of events from that day in January, just to make sure we're all on the same page. So in your testimony, you mentioned that the automated deposit requirements from DTCC came in at 5:11 a.m. Eastern, and it showed a $3 billion deficit, correct?
I believe that's correct, yes.
Okay. At that point, 5:11 a.m., did you have the liquidity to meet the additional $3 billion deposit requirement?
So as we wrote in detail in my written testimony, there were a series of steps that the Robinhood Securities team took to
reclaim my time, sir. At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
Okay. So when you said, and you've said this multiple times, that you did in fact have the liquidity and you didn't have a liquidity problem, at that moment in time, that is not necessarily true, correct? You had to take steps to get there.
Congressman, we did have to, the Robinhood Securities team had to work with our relevant clearinghouses to adjust the risk profile of the trading day in order to meet our collateral requirements.
Right. And in order to do that, your choice was to throttle trading to prevent your clients from being able to purchase in certain shares, correct?
That's correct. Robinhood Securities had to restrict buying in about 13 securities.
Okay. And if you had not been able to de-risk the profile or the portfolio, excuse me, you wouldn't been able to raise the money, get the VAR requirement and the excess capital charge waived to de-risk the portfolio, then DTCC would have stepped in and liquidated the portfolio, correct?
I'm not sure what the exact, Congressman, what the exact steps that they would take if we weren't in compliance with the deposit requirements would be, but it would not have been a good situation for the firm or the customers.
So reclaim my time. So the letter that Ranking Member McHenry submitted for the record, I would draw everyone's attention to. I'll just read this. If a clearing member fails to satisfy a margin call, it exposes other clearing members to risk and can put NSCC out of compliance. In a case of non-payment, NSCC may cease to act for the clearing member and liquidate its unsettled clearing portfolio. So that was definitely in the cards. For my constituents who are Robinhood clients, what would this have done to their portfolio? if it would have been forced liquidation as a result of missing the capital call?
Oh, well, Congressman, if there was forced liquidation, at the very least, it would have resulted in a total lack of access to the markets for your constituents, not just to the 13 securities that we restricted buying in.
Right. So this would have been an enormous catastrophe for Robinhood, correct? And the
That's
clients.
correct. And not just Robinhood, but the over 13 million customers that we serve.
Yeah, and I think that's really sort of the crux of the issue. So in a sense, I love your company because it does, when correctly managed, provide investment opportunities for individuals who are currently frozen out of the markets for one reason or another. At the same time, though, I believe a vulnerability was clearly exposed in your business model and perhaps in the regime that governs your capital requirements. And we just can't live in a world where my constituents could have their shares liquidated without their consent because you all aren't able to make a capital call. I appreciate that you were able to ultimately satisfy it. But the amount of time you have from 5 a.m. to 10 a.m. to figure this out is scary for the company. And frankly, I care more about my constituents than anything and scary for them. And so I hope we'll continue to look at that.
I wanted to first begin by congratulating everybody who made money on the Robinhood trade. You know, you guys found a low float, low volume, massively shorted stock, and you guys squeezed it. And I think that investors like Mr. Plotkin, large money managers, probably doubled down on their short positions thinking that they're going to win. And in the end, the massive communication networks that we have these days rallied the small to beat the large. And that was absolutely something to behold. And Robinhood made that possible. Robinhood made that possible. Mr. Tenev, you mentioned in your testimony that you secured $3 billion in funding to address the regulatory deposit requirement situation that you faced. Where did that $3 billion come from?
Thank you, Congressman, for that question. To be clear, we were in compliance with all regulatory net capital and deposit requirements without the additional capital infusion. It was simply to provide extra cushion, allowing us to unrestrict trading and be prepared for other black swan events that might happen in the future. The capital came from mostly existing venture capital investors that Robinhood already had.
So basically, you had to further dilute your position in Robinhood in order to make sure that you secured all of your 13 million customers with that additional $3 billion.
That's correct, Congressman.
Well, that's where I have a serious concern, Mr. Tenev, because not only was your business model designed to profit off of order flow, which caused you to take extraordinary risks in having 13 million customers with access to large margin trading that facilitated the GameStop situation, but you halted buys on that stock and you allowed sells in order to mitigate the capital requirement situation, and you materially benefited from it. You materially benefited from it because it reduced the amount that you would have had to go out and raise an additional capital in order to prevent these kind of crises from reoccurring. You took from your customers in order to minimize the $3 billion from being larger than it probably would have been, because you wanted to protect your position. And that is very troubling. That is very troubling. It's very troubling that the order flow model that you built and the risk that you took on resulted in that halt. And it's very troubling that halt also materially benefited the existing shareholders and yourself by minimizing the amount of additional capital you had to raise in order to prevent that from happening again. You basically took from the shareholders in order to do that. And that's just, I don't know what to say about that, but I think that this, Madam Chair, presents a very serious situation where we need to ensure that companies are not taking advantage of customers in this way. Mr. Tenev, you're quoted as saying in this hearing, buying increases capital requirements, selling does not. So it was something that you knowingly did. It was something that you knowingly did. It was beyond just trying to protect the existing customers. And at the end of the day, while you had to raise an additional $3 billion, it minimized that from being a larger sum. We have customers who purchased the stock who are now bag holders after the price came down because they couldn't continue going up with additional buying. And that was willful, that was intentional. So I'm glad, Madam Chair, that we've called this hearing. I'm glad that we're able to put these things on the record. And I'm just very, very concerned with the implications of this. And I really hope that at the end of the day, those bag holders get a lot more than an apology. Thank you, Madam Chair, and I yield back.
Thank you, Chairwoman, and thank you to the witnesses for being here today. I just want to quickly follow up with a question my colleague, Mr. Foster, asked earlier to you, Mr. Tenev. You said that Rule 606 reports detail the arrangements you have with firms like Citadel. However, those only detail the payments you receive. Are you saying that you're prepared to publicly disclose the detailed terms of your payment for order flow with Citadel and other market makers?
Thank you for the question, Congresswoman. The 606 reports do publicly detail the payment for order flow arrangements we have with Citadel Securities and our other market makers.
Okay, well, I'll look forward to seeing those details then. Will you make sure that you get those over to our committee?
Certainly, we can have that arranged.
Going to lead us down the path of additional regulations before we fully investigated the facts. It was stated earlier that may not be the case, and I'd like to have inserted into the record a Bloomberg article dated January 28th titled "GameStop Trades Show Need for More Regulation," Democrat says.
Without objection, such is the order.
Thank you. I think it'll be helpful for everyone to review that, with the concerns being that we're going to drift away from the democratization of our finance system. Also, a bit disappointed that we don't have representation in our first hearing here today from the SEC or the DTCC, especially in the early days of the Biden administration. I think that would be helpful, and hopefully we'll be able to have their participation in a future hearing. If I can direct my first question to Mr. Gabe Plotkin at Melvin Capital Management. There's obviously a lot of attention that came pouring in on a stock, GameStop, that you held a short position in. People were tweeting about it, things were building. Do you have any information as to uniquely why folks on Twitter and on Reddit and others uniquely targeted that stock?
First of all, thank you for the question. I think it's a really good one. I think ultimately, I'm not sure kind of how the momentum built around that. You know, there were certainly some signs, you know, as we kind of diligenced after the fact. I mean, there were even website names bought, like, you know, nasty things about our firm as far back as November. So I'm not sure kind of how it started, but I think ultimately they saw an opportunity with a very high short interest stock that a lot of people could relate to, you know, because it was a retail experience, and that's sort of the genesis of it.
Thank you very much. I'm going to shift gears over to Robinhood and Mr. Tenev, if I can. As my colleague Mr. Gonzalez was talking about, at some point it became clear that additional collateral would likely be needed. How many of your customers owned GameStop stock or options on January 27th?
I don't have the exact numbers.
Suffice it to say, had it increased? Suffice it to say, had it increased dramatically over the days leading up to the 27th?
Yes, that's accurate.
Fair. And you saw additional order flow coming into this. Did you take any steps, and was it reasonable to believe that there would be additional capital requirements? And did you take any steps, either internally or working in concert with the National Securities Clearing Corporation, to mitigate the risk posed by the volatility before the January 28th collateral call?
We did. So on January 21st, we went to 100% market requirement for AMC. And that requires all purchases for those stocks to be fully paid for. So customers would have been unable to use margin to buy those. So that was January 21st in the case of AMC, and January 26th for GME.
But this was still insufficient ultimately as related to the collateral call that came in the early morning hours on the 28th. Is that correct?
That's correct. The limiting margin was ultimately insufficient.
And as you look to your peers, do you know any other brokerages that were putting in place limitations on their buy orders?
Yes, I do, Congressman. I think that's an important question. Many brokerages put in place similar limitations on buy orders for many of these securities.
For the record, I've heard conflicting reports on that. I think it's something that this committee needs to further look into, is to the differential between what occurred under your control at Robinhood and some of the other brokerages. I think it's a question that we should fully investigate on this committee, make sure we have all the facts as we're moving forward. Could you detail, Mr. Tenev, your plans going forward as it relates to making sure that an event like this doesn't occur and that you have the foresight to prevent these late collateral needs?
Absolutely, Congressman. Thank you for that important question. Certainly, the additional $3.4 billion helps provide significant cushion. In addition, you could see that between Thursday and Friday, Robinhood replaced the PCO, which was a position closing only setting with much more granular position.
Thank you, Madam Chair. It seems we're here today to try to find culpability in the events that transpired last month. I seem to spend a lot of my time thinking about capital requirements and the time it takes to execute these trades. So I'm going to focus my questions there. Mr. Tenev, you have repeatedly invoked capital requirements that both your company and your clearinghouse are required to abide by in order to explain the restriction of trading last month. My friend and colleague, Mr. Barr, asked you about this earlier, but I would like to hone in on this a little bit. Could you explain what specifically about the nature or volume of the trades being ordered by your customers caused these increased capital requirements to be triggered? And how did the level of collateral required compare to what you would normally have to abide by?
Thank you for that question, Congressman. So to give you a sense for the increase, our capital requirements, our deposit requirements with NSCC from January 25th to January 28th, so a span of 3 days, increased tenfold.
What is the most your capital requirements had been prior to this event?
I believe there was a table, Congressman, that I provided in my written testimony that had the precise value at risk and special charges in the prior days. Happy to refer
But obviously,
to that.
it never been close to this amount, and now you have additional capital that you've raised, and so this should not happen again. Again, I think you referenced 1 in 3.5 million was the likelihood of this situation occurring. Is that correct?
That's correct, and that's not a Robinhood number. That's actually a third-party industry number.
Are you aware of the origin of these capital requirements?
I do believe that these capital requirements, and specifically the NSCC deposit, was spelled out in Dodd-Frank.
So the Dodd-Frank Wall Street Reform and Consumer Protection Act is arguably to blame for what happened. You would not have halted trading in this case, but for this exorbitant capital requirement that you were unable to meet. So I think that when we're searching for culpability, we need to realize that the well-intentioned legislation from over 10 years ago is somewhat culpable in this entire conversation. Ms. Schultz, will you elaborate on that? Do you agree that Dodd-Frank is somewhat responsible for the situation that Robinhood found themselves in?
I think the capital requirements in Dodd-Frank can be seen as responsible. I think it's incumbent on us to evaluate those capital requirements and whether they are appropriate given the business models at issue. I think that's also a question of settlement times and modernizing our system. But I agree that the capital requirements here put into place are one of the reasons that we're having these conversations today.
And you went to the next place I wanted to go, which is the time it takes to settle these transactions. So, 12 years ago, 10, 11 years ago, we never really considered the whole concept of a Robinhood, of an app-based trade platform that democratizes access to purchasing and selling publicly traded companies. So I do think that needs to be revisited, especially because it is unfair. There are other companies that have far more resources that are not in the situation, and those companies have larger investors. So we really are picking on the little guy in this entire conversation. So between reconsidering capital requirements for retail investor platforms, number one, and number two, trying to find a way to settle these transactions faster, those two things seem to be the best way to achieve our objective of making sure this doesn't happen again. I do hope that we can hear from Michael Bodson from the DTCC in the next hearing, or perhaps someone from the NSC. I'm hearing something strange on my computer. I'm sorry, one second. Thank you. I'll end with this. One of my colleagues across the aisle said the deck is stacked against the little guy, and I couldn't agree more. But in this case, the very committee that is conducting this hearing has more culpability, I would say, than any of the witnesses that we have brought before us today. So we need to make sure this doesn't happen again. I look forward to working with my colleagues across the aisle. With that.
But I'm not sure that we really understand how the margin call changed from 3 billion to 1.5 billion to 600 million. Can you sort of go through how did you negotiate the margin call down? And these are very sizable decreases, right? You're saying 50% to 50% again to something that you could then in turn manage. How did you decrease the margin call? I'm sorry, you're on mute. you're still on mute. I haven't been able to hear a word you said, unfortunately.
How about now?
I can hear you now. Madam Chair, can I have 30 seconds back for that?
Congressman, I appreciate the question. And first, I want to send my thoughts and prayers to the people of the great state of Texas. I appreciate you mentioning that. I'd like to just refer to my written testimony, which gives the detailed tick-tock of everything that happened. I believe pages 9 to 11.
No, I've read that. I don't. But like, did you go in and say, hey, you need $3 billion, but hey, I won't sell these stocks if you reduce it, and that's how you got to the point where people could only sell the stock, not buy it? Is that what you did?
I believe
because that's not in your written testimony. So I'm just trying to get your answer.
I don't believe we had made any decisions on PCOing the stocks between the initial $3 billion request and the subsequent $1.4 billion request. But between the $1.4 billion and the roughly $700 million, there was a discussion between our operational team at Robinhood Securities and their relevant counterparts at NSCC regarding what measures we intend to take to lower the risk of our portfolio.
Okay, so in other words, if you had $3 billion, your customers would have been able to do everything they wanted to do, including purchase more GameStop. Is that correct?
I don't want to speculate on that. You know, if we had infinite capital, certainly. But I think it's also important to note, Congressman, that this was an evolving situation. We hadn't seen it before. We had no idea what Friday would have looked like had we been able to allow customers to buy these securities unrestricted on Thursday. So I think it's difficult to speculate exactly how things would have been different.
But I mean, isn't the reason they said you need $3 billion because your customers wanted to buy GameStop, and then by saying, hey, they can't buy it, they can only sell it, that reduced the capital that you needed? I mean, it seems to me that's what happened, but I'm just trying to get it.
They weren't saying specifically that nobody, I believe, didn't want our customers to buy GameStop. These are regulatory mandated deposit requirements, Congressman, that we had to comply with that were heavily influenced by the concentrated activity in GameStop, AMC, and the other securities.
Well, wouldn't it be fair to say that your firm was undercapitalized to allow your customers to do what it is that you wanted them to be able to do?
I think, Congressman, you know, that in this case, certainly if we had the additional capital, we would have been able to ease restrictions or perhaps with sufficient capital, unrestrict altogether. I think it's important to note lots of other firms did essentially similar things, if not the same thing, in restricting the buying. So this was really more of a systemic problem rather than a uniquely Robinhood problem.
But didn't the fact that you went out, raised more capital so that you can actually answer this problem in the future, doesn't that also belie that you were undercapitalized on the 28th of January?
Again, Congressman, we met all of our regulatory capital requirements and deposit requirements.
Your customers wanted to buy the stock. You wouldn't let them do it because you didn't have the capital to allow them to do it, right?
Yes, we didn't have the deposit requirements.
I think that's really a core problem that I think this committee hearing has shown me is that you were unfortunately undercapitalized to help your customers do what they wanted to do. I yield back.
Thank you very much, Mr.
Is there anything you would like to add to this hearing that you haven't been able to add yet, given that we're past the 4-hour mark on this hearing?
I appreciate that, Congressman. I do. I don't have anything to add at this time, just that I would be the first to acknowledge that investing in stocks and options is incredibly risky, and it's so important for people to do their own thorough research before investing. But that said, I tend to agree with you that folks should be able to freely express their views on a stock, and they should be able to buy or not buy a stock based on those views that they may have.
And Mr. Gill, on that note, so how would you feel if these brilliant people that are asking you these questions today decided that you should not take the risks that you're making these thoughtful decisions on? What do you think about that?
I would probably ask for an explanation, Congressman, and to try to understand their viewpoint as to why they might think that, and perhaps we'd be able to talk through it.
Right. I appreciate it, Mr. Gill. I think we need to value the right of the individual to make decisions for themselves. And it's fantastic to see so many people getting involved and participating in the greatest financial markets in the world. We should be encouraging individual participation in the market by you and others. And we should want more people, more, not less. We don't need the people from the mountaintop deciding who's capable and who's incapable. We need more people having the opportunity to develop financial literacy to build their own portfolios, to secure a safe and comfortable retirement, to grow their wealth so they can send their kids to college. And most importantly, in my opinion, we should strive for individuals to have the autonomy to do all that they themselves would want to do without having to rely on others or, God forbid, their government. I also want to thank Mr. Budd for using his time to mention blockchain technology applications and the post-trade settlement and clearing process. In light of this whole situation, it's important now more than ever that we utilize the technology that we have access to, and we don't have access to technology, and we do, have access to technology that is decentralized and can provide real-time trade settlements. Mr. Lynch and I have a nonpartisan bill that we will reintroduce very soon that concerns this. If we should exercise oversight of anything here, it's to ensure that individuals maintain access to our markets, individual investors, and discussions about over and undervalued companies only continue to increase. Unfortunately, average investors were locked out of the markets at a time of extreme volatility, while institutional investors were not. Well, I understand that a lot of what happened during this market frenzy came down to liquidity issues. Individual investors were in a vulnerable position and were at the will of online brokers. We should be taking this time to discuss how to move forward in a way that promotes market access to all investors, just like it did last month. Congress clearly does not understand what credit is and how you utilize social media and catalyze the market movement. We've significantly underestimated the sophistication of America's retail investors, and we've not been focusing on improving market access.
The gentleman's time has expired.
Madam Chair, I appreciate
You're recognized for 5 minutes. Mr. Lynch?
Thank you, Madam. What is the likelihood that GameStop and AMC's market volatility was largely driven by institutional investors looking to ride the wave?
Look, I think these are questions that we are going to find out the answers to as we get deeper into the data. But I think that it's likely that at some point in this increase in value for all of these stocks, institutional investors were involved. Retail investors traditionally have not been able to move markets in the same way, but it's important to note here that these were not large stocks to begin with. This was not a massive increase in price in Apple or Google. It was GameStop, a much smaller company. So the ability of retail investors to have outsized influence here is entirely possible as well.
Thank you, ma'am. Mr. Griffin, Mr. Plotnick, do you have any thoughts on this likelihood as well?
Congresswoman, I believe you are asking one of the single most important questions posed today. And I believe that the decline in the short interest as reported over the 2-week period of time, that the U.S. updates short interest reporting every other week, indicates that roughly, and I apologize for not having the exact number, but roughly 35 to 40 million shares were bought back by parties that were short the stock. This would be a dramatic degree of short covering that could cause a dramatic increase in the price of GameStop.
Okay, thank you. Mr. Plotnick.
Yeah, hi, thank you for the question. You know, I think, I don't have the exact answer to your question. I do think it's worth noting that, as the stock price moved higher, there was a 3-day period where it traded almost 11 times the entire float. And so I think that kind of volume gave anyone who was short ample opportunity to cover and probably suggests tremendous either frenzied buying or institutional buying or some sort of combination. We did look at some of the options activity in the stock. And, on Friday, January 22nd, there was options that were expiring that would have equated to 35 to 40 million shares of stock ownership. So I actually don't think the short covering was the biggest driver of the stock. When you kind of look at the volume, I really think the biggest driver was the aggressive options activity, and then whether it was institutional or retail, just the collective buying.
Okay, Mr. Griffin.
This truly is a yes or no question. Is Citadel's trading algorithm programmed to identify and trade ahead of large trades done by pension and retirement funds? Yes or no?
Congresswoman, today, virtually all trades executed by institutional investors are in the form of program trades such as VWAP and other algorithmic trades.
So that's a yes, right, Mr. Griffin? Just
no,
so it's
I'm answering the question. It's a very complex question that deserves an appropriate level of answer.
okay.
These VWAP trades are not large trades that you can, it's not like there's 10 million shares about to be bought. It is a trade that is sliced into small slices, 100 or 200 shares, and executed over the course of a day, a week, or a month.
Well, help me out with this one. Does this increase cost, this kind of algorithm or whatever program to identify and trade, the computer's doing the trading, does this increase cost for people who have pension and retirement funds, yes or no?
So given that we, for example, manage money on behalf of pension.
Oh, well, I really, because they're so timed. This is not out of disrespect. We just got a limited time.
We use VWAP orders to execute on behalf of our hedge fund and have generated exceptional returns for pension plans and for endowments. So
well, I'm going to help you out. I'm going to help you out, Mr. Griffin. In effect, some estimates indicate that as a result of the high frequency trading, though, pension and retirement accounts pay nearly $5 billion in a tax. This means that Wall Street firms like yours engaging in high frequency trades are actually making money at the expense of my residents' retirement funds. So one way to ensure that this enormous wealth generated on Wall Street actually reaches the real economy, y'all, you know, what's happening right here in our communities and in my district, is to enact and look at proposals like a financial transaction tax. And let me tell you, according to recent polling, the majority of Americans, all of you need to hear this, and it's going to grow, the majority of Americans support taxing Wall Street transactions. Taxing them at just 0.1% would actually raise $800 billion over 10 years, which could fund programs like helping my district expand healthcare, nutrition, public education. I heard my friend from Texas, who we all are praying all the families will be taken care of, talk about access to water and electricity. But guess what? Right now in my community, it's so poor that I have families melting snow so they can flush their toilets because they have no access to water. So this tax to me would discourage risky and high frequency trading, unfair high frequency trading. Mr. Griffin, does Citadel's lobbyist right now been hired to oppose federal proposals to financial transaction tax because it would make high frequency trading less profitable?
So we firmly believe that a transaction tax will injure Americans hoping to save for retirement. Yeah. I believe that Vanguard has publicly come out and said that we'd have to work about 2.5 years.
Well, I want to make this, yeah.
I'd like to finish my answer. I think it's important.
Oh, no. I'm reclaiming my time. The Hong Kong stock market, Mr. Griffin, imposes 0.2% tax on transactions as a result and sees little high-frequency trading. But this hasn't stopped the Hong Kong stock market from thriving or becoming the third largest in the world after New York and London. So just to be clear, let's not gaslight the American people. Y'all be fine with the tax. And it's fair because let me tell you, our folks are tired of bailing you all out when you screw up and gamble with the retirement fund. And that's exactly what happens every single moment. And that's the reason why we're having this hearing is that sometimes you are irresponsible and it's set up in a way that helps only the wealthy and leaves people like my community here with this large income inequality that I feel like never ever gets the bailout it deserves. Thank you so much. I yield.
Earlier, one of my colleagues, Representative San Nicolas, said that Robinhood owes its customers a lot more than an apology, and I happen to agree with him. I believe that the decisions made by you and this company have harmed your customers. Mr. Tenev, would you be willing to commit today to voluntarily pass on the proceeds of the payment for order flow to Robinhood customers?
Congresswoman, I appreciate that question. When the statement you refer to was made, I believe 2015 or 2016, it was before Robinhood forced the entire industry to drop commissions and replicate our business model, which made payments.
So is that I should take that as a no, you're not willing to pass on the proceeds of payment for order flow to your customers?
When the other brokers dropped.
I'm just talking about today, right now.
Payment for order flow, Congresswoman, allows for commission-free trading. In the context of trading commissions, it's a much larger source of revenue in the past than payment.
Mr. Tenev, I apologize, and I don't want to be rude. I just have limited time. But if removing the revenues that you make from a payment for order flow would cause the removal of free commissions, doesn't that mean that trading on Robinhood isn't actually free to begin with? Because you're just hiding the cost in terms of potentially poor execution or the cost of lost rebates to your customers.
So certainly, Congresswoman, Robinhood is a for-profit business and needs to generate some revenue to pay for the costs of running this business. People were initially skeptical that the model, even with payment for order flow, would work when you remove commissions. And I think we've proven that otherwise by making this the standard model by which brokerages operate now.
I see. Okay, Mr. Tenev, I have to move on very quickly. I have a timeline.